Hey, this is Chris. Now, one of the best regarded and best read, I think, finance and personal finance books in Australia for many years now has been The Barefoot Investor, which Scott Pape put out originally many years ago, and later on he's put out subsequent books, The Barefoot Families and now Barefoot Kids. We also had the fortune to actually interview Scott Pape for our blog many years ago, which we can put a link down the bottom in this video for. But we get a lot of questions from our clients around our investment strategy and how closely it aligns with those strategies that Scott espouses in his books. So in this video, I wanted to talk a little bit about what I understand the Barefoot Investor investment strategy to be, and talk about where it's similar or different to StockSpot's investment strategy. So I would say that Scott's Barefoot Investor strategy really circles around a passive investment approach that utilizes low-cost index funds and recommends a minimal amount of trading and a long-term perspective. And the aim of this strategy is really to benefit from the long-term growth of the markets and to help avoid the tyranny of fees and costs, which basically pull money out of your account and send it to the investment industry. So it's definitely a strategy that aims to minimize costs, but also improve your opportunity to get access to great returns over the long run. Now, I think ultimately this is a strategy that's very similar to the strategy I believe in and our team believes in it at StockSpot. And so we actually have quite a lot of alignment in our philosophies. So StockSpot, like the Barefoot Investor strategy, really focuses on building diversified portfolios that are spread across lots of different investments and assets. And this is also done to help reduce the impact of any single one investment on your overall performance. So, one of the key tenets of our strategy is diversification, which I think aligns very well with the Barefoot Investor strategy. The second one is low-cost index funds. Now, I've been really flying the flag of index funds since I started StockSpot back in 2013. I believe very strongly in their benefit and that really they're the best investment tool for most retail investors in Australia and around the world, really. The Barefoot Investor, in a similar way, really talks about the benefits of index funds, index investing. I know the super funds that Scott has recommended in the past have been very much funds focused on low-cost indexing, and he picks often the lowest cost funds in the market to recommend to his readers and subscribers. And so when it comes to index funds, I think we're also pretty well aligned in terms of our philosophy. And then the third one is the time perspective. So, when we recommend portfolios to our clients, we're very conscious that in order to get the best potential return, you need to understand that investing is a long-term game and you can't expect to make returns necessarily over the first few months or even the first couple of years. So we recommend for all of our clients to be thinking to invest for at least 3 years, and in many cases longer than that. I think in a similar way, the Barefoot Investor approach is a long-term approach. It really focuses on building wealth slowly and gradually over the long run, rather than trying to pick the latest trends or make money quickly, which, sometimes people do in the short run, but it's a pretty unreliable strategy over the long run. So overall, I would say that the Barefoot Investor strategy aligns pretty perfectly with our own investment strategy at StockSpot. It's why we recommend index funds to our clients. It's why we recommend a long-term approach and also keeping fees as low as possible. I think one of the differences between our approach is probably, our focus on ensuring always that your strategy aligns with your time horizon. So we probably have a bit more of a focus on that, because ultimately your asset allocation, even if you're in low-cost index funds, may not be right for your personal circumstances if you're taking too much risk, let's say, and are aiming for a goal that's only 5 years away. So the advice that we provide and the extra work that we do really tries to align time horizons of our clients and the risk capacities of our clients with their investment strategies. But apart from that, I'd say our strategies are pretty similar.